Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome back our good friend, Cox Senior Economist Charlie Chesbrough. Charlie, it's been a while, and I know you have a lot to catch us up on, so I'll let you take it away.
All right. Well, thank you very much. And yeah, we do have a lot to cover today. And I think the overall message to get through there is the automotive outlook still remains optimistic. I think last time I was with you, we talked about being cautiously optimistic. And that really remains what our view is here as we end the first quarter here of 2024. We see vehicle sales improving out there just a little bit. But clearly risks still remain, and that's what we're going to talk a little bit about here today. So we're going to go through sort of the economic and automotive outlook. I'm going to talk a little bit about the soft landing scenario. That's the idea that the Fed's going to be able to raise interest rates and get this inflation under control without causing the economy to fall into a recession. And so far, it looks pretty good for that. And then I want to walk you through our latest results from our dealer sentiment survey, what dealers' view is on the economy out there and vehicle sales. And then I want to walk you through some of the key trends, give you an update on changing market shares, changing prices and inventory, and then talk a bit about the alternative propulsion markets, electrics, as well as plug-in and traditional hybrids, and then end by giving an update on what we're seeing with used vehicle prices. They continue to decline, but we are expecting to see those slowly moderate here by year end. But let's start by talking about economic growth. And this is a chart that's showing the Bureau of Economic Analysis overall economic growth, real economic growth for the U.S. economy on a quarterly basis. And you can see where we are today here in the first quarter of 2024. We're just coming off of a couple of quarters of very robust growth. Back in Q3, we almost hit 5%. In Q4, it was a little over 3%. But the expectation is that from here forward, and this is the forecast from Moody's Analytics, the expectation is the economy is going to slow from here. We're already starting to see a bit of a pullback in consumer spending, and that's a huge chunk of economic activity out there. And that's going to start to slow. So when we look forward into 2024, we're not going to have the same 2.5% economic growth rate that we had in 2023. And in fact, over the next couple of years, the expectation is the economy is going to kind of creep along at around a 1 to 2% growth rate. And so that's going to be, it's certainly not going to be a negative for vehicle sales, but it doesn't mean we've got a lot of support winds behind us in terms of strong economic activity to demand more personal transportation. But the outlook out there continues to improve, and we can see that when we look at consumer sentiment. This is from the University of Michigan. They do a survey of consumers around the country, and they have for almost 50 years. And so I'm showing here about 50 years worth of data. And you can see where we are there on the far right, and that consumer confidence has been creeping higher from where we were in June of 2022. And it's important to point out that in June of 2022, consumer sentiment in this country reached the lowest point it has at any point in the previous essentially 50 years. And we can go back to the double dip recession of the early 1980s and the S&L crisis of the late 1980s, early 90s, the 9/11 terrorist attacks, and of course the Great Recession of 2008, 2009. All of that, the low points of that were less than the low that we hit in June of 2022. And we're sort of in the process of recovering from that. That was a massive shock that the economy was going through, and that was caused by the increase in prices. That is when inflation really hit its peak here, the recent inflation, and it really scared consumers around the country. And we're still in the process of recovering from that. But we still remain far below that purple line, which is sort of our long-term average, but we are heading in the right direction. So this is why there still appears to be some optimism out there that things are moving where they should be going. And part of the reason for that is inflation. It's definitely been improving dramatically from where we were just a little over a year and a half ago. This is a chart that's showing the year-over-year change in the consumer price index. And again, I've got about a little over 60 years worth of data here. And you can see that in June of 2022, we really reached a tremendous peak in prices here as we had the global supply crunch was really jacking up prices around the country and really around the world. The United States wasn't the only one to see this kind of inflation, and we reached levels that we hadn't seen since around mid 1980 or early 1981. That's when the Fed really started to tackle this aggressively. They were raising interest rates in order to fight off this inflation, to slow down the economy, and they've been very successful at it so far. The most recent data point, however, in February, the inflation rate creeped back up to 3.2%. That's up from 3.1. So there is a little bit of a concern that yes, inflation is improving, but we still got a little bit of a ways to go. And it's really this last bit of that last 1% or so that's going to be so difficult to get to, because it's really sort of housing prices are really the main factor now that has to come down. And that's a real tough one to make move. But the concern was is that we were going to see these rising interest rates that the Fed did, that was going to tip us into a recession because consumers were going to pull back, businesses were going to pull back, but it's just not what we have seen. And we can see by looking at the unemployment rate, we still remain very close to historic lows. On the far right there, the most recent data point, 3.9% unemployment in February, well below that 4% threshold, and it still remains very close to the all-time lows that we saw back in the late 1960s, early 1970s. And so this idea of the soft landing so far has been holding up. But I will say that the unemployment rate has been ticking higher over the last 9 months or so. We hit a low of about 3.4% last April, and I guess it's a little bit longer than 9 months. But we hit a low of about 3.4%. We're now a half a percentage point higher than that. So unemployment has ticked up a little bit, but it certainly has not gotten out of hand. So this is why a lot of folks think that the soft landing appears to be where we're headed. But was a lot of concern out there that recession was right around the corner, and part of the reason many folks were concerned about the prospect of a recession last year was that we saw that the interest rate curves inverted. And what that means is that the near-term interest rate is higher than the long-term interest rate. And this is a chart that's showing the 10-year Treasury minus the 2-year Treasury. And normally, when you're loaning money to the government, if you're going to loan it out for 10 years, you want a very high interest rate because there's all kinds of things that could happen over that 10-year span. There's a lot of risk involved. So you want a greater interest rate than you would want if you're just lending for a shorter period of time. But when that yield curve inverts, it means that the markets are saying they're much more concerned about the near-term prospects than they are the longer-term prospects. And so 2-year Treasury interest rates go higher than the 10-year, and that's when the yield curve inverts and it goes negative. And why this is so important is that generally, historically, when we look back in time, that when the yield curve inverts, and that's what this chart is showing here, that the yield curve spread going back to 1976, that whenever that inverts and has gone negative, the US economy has slipped into a recession just a few months afterward. And that's what I've highlighted on here. You can see the blue bars go negative, and then we had periods of recession that followed just a few months later. And the reason for that is that generally the banking system can't operate well in this type of environment. Banks which borrow short and lend long can't do much activity in this type of environment if short-term interest rates are so high. And so generally what happens is there's a lot of credit availability that dries up across the economy because banks and other lenders out there don't want to lend in this type of environment. So credit availability gets much more challenging, and generally the economy slips into a recession as a result. We're in a little bit different situation this time around, even though we've seen the yield curve negative for such an extended period of time. There's been so many moving parts out there in relation to the COVID recovery and the supply chain recovery and all of this that it's mitigated some of the concerns that we would have normally. So the recession has been able to kind of be offset, but that risk still exists out there. And so many folks are keeping an eye on that. And we are starting to see signs already that credit is tightening out there in the economy. This is a chart that's put out by the Federal Reserve Bank from their loan officer survey. And the Federal Reserve talks to loan officers at banks all across the country, and it asks them, are you tightening standards for your loans? And this chart is showing the lines here for a couple of different loan types. But in dark blue, this is the net percentage of banks that are tightening standards on new and used auto loans. And if you're above zero, it means more banks are tightening standards. And when you're below zero, it means fewer banks are tightening standards. So essentially, it's a looser credit. Well, you can see where we are when it comes to auto loans, that it's well above of zero, suggesting that standards out there are very, very tight. And it's not just auto loans. You can see that for other types of loans, in terms of commercial loans to small companies and medium and large companies, that orange and green line, those have seen significant pullback in credit availability, much more tightening out there, as well as on mortgage loans. But you can see all of these data points in the most recent numbers do appear to be ticking down back towards zero. So it's not quite as bad as it was, but we're still seeing that a majority of banks out there are tightening standards. So that credit crunch that we're concerned about does appear to be happening, although maybe not too severe. But we also can see it in some other numbers out there, this credit availability issue. This is from the Federal Reserve Bank's Consumer Credit Panel, and this is showing the total dollar amount of auto loan originations and by the different credit tiers. And the key takeaway here is on the far right, that you can see that over the last few quarters, the amount of lending being done to the automotive sector has been in decline. And in fact, auto loan originations declined by about 10% in 2023. So the amount of auto lending out there is declining. There's just not as much credit being made available. Now, the one silver lining in all of this is that subprime share of the credit that is being made available is very, very low. And that's what that jaggedy red line there is. And you can see back in just prior to the Great Recession, 2007, 2008, subprime share was very, very high. Almost 30% of all auto lending was to folks with a 620 FICO score or lower. But you can see from where we are today on the far right, it's half of that. Just about 15% of the loans out there are to subprime borrowers. And so, although credit is a little bit more challenging, the credit quality remains very, very strong, that we're really only lending to sort of the best credit customers out there. And so that's helping to mitigate some of the concern out there. And we can see that being reflected when we look at delinquency rates and default rates. This is a chart that's showing the number of auto loans out there that are in severe delinquency, or 60 plus days overdue on paying their monthly bill. And that's what that orange line is. And you can see that where we are today, that delinquency rate is very, very high. It's much greater than we had even during the Great Recession. So a lot of folks out there are having a difficult time right now making that auto loan payment. And certainly the rising interest rates are squeezing consumers and personal credit cards, so that many folks are having a hard time out there making ends meet. But what we can see from the red line is that the number of those delinquencies that become defaults still remains relatively muted. We haven't seen the same increase in defaults along with delinquencies. It's certainly rising, so there is some concern out there, but it does remain below the levels that we saw during the Great Recession back in 2008, 2009. So part of the better credit quality that we have out there that we're lending to, the fewer subprime folks, we can see that is having some beneficial effect in that we're seeing that the default rate is not also spiking. But all of it does say that there's certainly a lot of risk out there, and that's why we remain cautiously optimistic. But there's certainly risks that remain. So overall, this is looking at light vehicle sales, and I left the whole history on here that we've got going back almost 50 years, just to show you the volatility that we do have in the vehicle market. And when we've had massive recessions in the U.S. economy, vehicle sales have fallen correspondingly, as you can see, sort of in 1982 and 1990 and 2009, when we saw huge dips in the market. But from where we are today, we finished sales at around 15.5 million in 2023. Our expectation is that in 2024, sales are going to increase just a little bit, up maybe a couple of 100,000 units. We're figuring around 15.7 million vehicles this year, and then another relatively modest increase in 2025. And really, the key driving force behind all this is that continued economic growth, a soft landing being achieved, that we are able to avoid having some sort of a recession, that all of that, as well as the rebuilding of inventories and the continued discounting from dealers, all of that helps to lead to a slightly better vehicle market over the course of the year. But as I said, there's still a lot of risks that remain. But I think it's important to point out that a lot of the froth from the vehicle market, those subprime borrowers, folks that were sort of on the fringe, that it's a real challenge to buy that new vehicle. We lost a lot of those buyers already from the new vehicle market. Certainly in the early days post COVID, and then in the inflationary period that followed, we lost a lot of those subprime borrowers from the market. So who remains today in the vehicle market is a much better credit quality, higher income, can get a better interest rate type buyer, and that person's probably a little bit more insulated from a downturn in the U.S. economy. So we just don't see the downside risk to vehicle sales as that strong. But again, that's assuming we don't have any kind of a major full-blown recession. So let's talk a little bit on the dealer's perspective, and they actually hold a fairly similar view to what we're seeing out there right now. Cox Automotive each quarter does a survey across hundreds of dealers across the country, and we ask them their view on how their business is operating and what their outlook is. And what this survey captures is essentially the 50 mark is sort of the neutral area, that if I'm above 50, I'm optimistic. I think things are sort of expanding. If I'm below 50, the dealer's telling us that they're a little bit concerned. They're more pessimistic on where things are headed. And you can see from this chart, uh, the orange numbers there are franchise dealers. And you can see that they've fallen over the last couple of quarters. Our most recent data point shows 49. That in general, dealers describe the outlook of where they're operating today is sort of neutral to a little bit negative. And it's, as you can see, their views have sort of fallen here over the last couple of quarters as they're getting a little bit more pessimistic as to how things stand today. So that is a little bit concerning. But we also ask them, what do you expect from the vehicle market in the next 3 months? And you can see that franchise dealers see a big jump, almost 10 points in the first quarter from where they were in the fourth quarter. So they're concerned about things as they stand today, but they are optimistic about tomorrow. And that's kind of where we stand as well, that we do think things are a little bit tough right now, but sales should pick up here a little bit more here as we get into later in the year. And the expectation is that we're going to get some support from the Federal Reserve as the ideas are going to start lowering interest rates, maybe as soon as May. But certainly expectations are that they will, when we get into the second half of the year, see a couple of interest rate cuts. So all of that will help some of the vehicle sales out there and help keep dealers on the right track in terms of their optimism. But the other thing we ask dealers about is their inventory levels and their profitability. And what's interesting here is you can see question 8 that we ask is, how would you describe the current new vehicle inventory levels? Well, that's that blue number, and you can see that that's really made a huge jump and is well above even pre-COVID levels in terms of what the industry is seeing for inventory levels. And that's a mix of inventory rebuilding across the country. We know that over the last couple of years that many brands were facing difficulties in acquiring product, and at different points in time, American brands were hit hard and early first, and the Japanese brands were suffering here late last year. But everybody seems to be on the right track now. And what dealers are telling us is out there is they're very pleased with where our inventory levels are at. So there doesn't appear to be any inventory crunch any longer, at least from the dealer's perspective. But on the flip side of that, we see that green line, and that's how would you describe the overall profits over the last 3 months. And you can see that dealers are saying that profits are getting squeezed, that the great days of 2021 and 2022 are now in the rear view mirror, and we're seeing that these rising inventories and the corresponding reduction in prices and the increased incentives is all having an impact on profitability, and dealers are not happy about that. So the sales outlook does remain optimistic, but in terms of profitability, it's definitely a bit under threat. And one of the things that dealers told us, though, is that we asked them, what are the factors that are holding back your business? And two of the main leading factors, the U.S. economy, of course, and overall market conditions, which are probably, I think, fairly similar, both of those showed a significant decline in terms of the number of respondents saying that these were a major issue for them. So they still rank high, but the number of dealers saying that is in decline. So it does appear that the economic environment in general appears to be a little bit less of a headwind as we're going into the second quarter here this year. The other factor that they mentioned was weather. That was a big factor. Certainly, they don't live in Michigan where I'm at because the weather's been a dream here for the last couple of months. But certainly in other parts of the country, they're facing a different situation. All right, so let's talk about some of the key trends that we're seeing in the market. And we'll start by talking about year to date brand sales. And so far in 2024, vehicle sales are up about 6% overall. That's that light blue bar there in the middle. But we can see that across some of the big brands, there's quite a bit of variation in terms of how sales have been behaving so far this year. On the far left, we can see that Ram is looking at a big decline in sales so far year to date. Certainly the Ram truck as well as their ProMaster vans, they're seeing their sales down quite a bit, and that's really taken Ram on the downside. Jeep as well is looking at year over year sales remaining negative, and that was off of a weak year last year. Part of a big contributing factor here is more the Jeep Cherokee that's kind of gone on hiatus until they get the new model year launched. So their sales are looking particularly weak. But at the other end, you see Toyota and Honda, they're looking at strong sales gains over last year. Part of the strong gains is the basis that we're coming from. Both Honda and Toyota were still looking at tight inventories a year ago, and so sales were muted back then. So they're starting to see some big sale gains over where they were last year. But certainly that's a very optimistic sign. And we can see Nissan is up big, although I think one of the key driving factors for Nissan this year is we are seeing quite a bit more fleet activity. And Nissan had pulled back in doing much commercial and rental fleet in the immediate post-COVID market, but it appears that they may be returning to that. And when we look at the luxury brands, again, you can see that Audi on the far left, they're seeing their sales down quite a bit. In fact, I looked into some of the details, and it was the Audi A3, A4, A5, A6, A7 were all down. Only the A8 was up on a year-over-year basis. And even many of their SUVs, the Q 567, all look down as well. So Audi's looking at some real trouble this year, probably because they've got a lot of competition out there. As you can see, that Lexa and Mazda both are seeing their sales improve over where we were last year. The other big trend that I just wanted to point out here is some of the big changes that we're seeing in the market prior and post-COVID. And on the left here, I'm showing brand share of vehicle sales. And I grouped it into sort of four big buckets, your Asian brands, your American brands, the European, and then the new EV directs. And some of the key trends that you can see that emerge from this is that light blue line. American brands, their market share has been in decline really for almost the last 10 years, but it's really started to accelerate in the post-COVID market. Some of this is intentional. The American brands pulled out of a lot of the compact car and smaller car segments, so they lost a lot of volume there. But we also know the pickup trucks have been under a lot of threat this year, certainly with the housing crunch that we've got out there. Activity has been muted. So none of this bodes well for the Detroit 3. And you can see that on the flip side of that, the Asian brands have been looking at very strong market share. When COVID first struck, you can see it hit the American brands particularly hard, and the Asian brands actually gobbled up some market share from them. They gave some of that back in 2022, but over the last couple of years, they've rebuilt on that market share, and so far this year, the market share continues to grow. And then we can look at the EV directs. Their market share continues to ride from essentially nothing 10 years ago to over 5% of the market today. And then the European brands have essentially been hovering around 10% and really haven't moved much. So there's some big changes happening out there in terms of market share. The other big changes we see is in terms of the luxury market, and that's what's on the right. I've got two charts here. One is the dark blue, and that's luxury brands without including the EV directs like the Teslas, and not considering them a luxury brand, just sort of our traditional luxury brands. And that dark blue line, you can see that even the traditional luxury brands have seen their market share rise dramatically here over the last 10 years. And even this year, it's down a little bit, but the peak year, the peak time of year for the luxury brands is in Q4, and certainly at the year end. That's when their market share really peaks. So the share does come down a little bit to start the year. But the trend is definitely that luxury is rising. So as we get a more affluent buyer in the vehicle market, there's much more traction to these luxury products. And so that share continues to rise. And when you include Tesla and Rivian and the other EV directs, you can see the luxury share has been rising even more rapidly. And we may be approaching 20% of the market here within the next couple of years. So, the affluence out there has really been changing who's in the market to buy, and it's changing the type of products that they buy. Another chart I wanted to show you was segment share. This is looking at the top 8 vehicle segments over the last couple of years. This represents about 80% of the total volume in the light vehicle market. And a couple of the interesting things you can see that jump out that over the last couple of years, compact SUV, subcompact SUV, compact car, luxury compact SUV, excuse me, everything compact is rising in terms of market share. When you talk about midsize SUV or midsize car, their market shares are in decline. And you can see full size pickup, that's been declining quite a bit as well. And so the consumers are looking for more affordable products, and there appears to be a shift away from the midsize more towards the compact as consumers are looking for a way to mitigate these high prices and find something that's a little bit more affordable for them and their budgets. And so when we look at transaction prices, they still remain high, but they're actually down a bit from their peak. This is data that comes from Kelley Blue Book, and it's showing the average transaction price that we've had here in the market over the last 5 years or so. And you can see that it's risen dramatically, certainly back in 2021 when the supply shortage started. That's when we really saw vehicle prices rise. We peaked at about close to $50,000 for a new vehicle back in December of 2022. But we're down from that now. We can no longer say that average vehicle price is $50,000 because it's not. It's closer to about $47,000 now, which is not to say that's anything to write home about, but it's a little bit better than $50,000. But we're down a little bit. And so far this year, we're down about 2% from where we were at this same point last year. So there is a little bit of weakness out there in terms of prices. Much of the price change is not being driven so much by the vehicles themselves, but maybe the composition of what is selling out there. As I just showed you, there's been a move towards more compacts, more subcompacts. Well, those all have a lower price point, and so that's contributing to the average price out there in decline from where we were just a couple of years ago. And of course, we're seeing an increase in incentives, and that's reducing that vehicle price out there. And that's one of the other big changes that we've seen in the market so far. Incentives have changed dramatically. This is a chart that's showing in dark blue incentives as a percent of the transaction price. And that was around 10% prior to COVID. About 10% was the incentive relative to the transaction price. That fell to about 2% in the post-COVID market, but it's now been rising dramatically. And it's now been back to close to about 6% is where we are today. And the other measure we can look at is price share of MSRP, or essentially the price strength. And that's that light green line. And we can see that back prior to COVID, that was around 94 or 95% was the transaction price relative to the MSRP. You can see that during the lean inventory days, that rose to about 102%. So essentially the transaction price and delivery costs was the price of the vehicle. There was very little negotiation to be had, but that's been falling as inventories rebuild. And you can see where we are today, that this seller's market that we had just a couple of years ago no longer exists. And it's now moving back towards the buyer's favor, where there's going to be more discounting and more negotiation to be had. So the conditions are changing out there, and they're changing for everybody. This is looking at all the different brands out there, the big brands. And we can see that in dark blue is the incentive as a percent of transaction price that they had back in February of 2023. And then in green is what we had just last month. And you can see everybody's increased their incentive relative to transaction price over the last year, but some much more than others. And I actually sorted this by that red dot. What's the biggest difference that we've seen on a year over year basis? And so the leader of that is Hyundai. They've had the biggest change they've increased their incentives by about 5% from where they were, incentives as a percent of transaction price, from where they were a year ago. Versus on the far other end, you've got Toyota and Jeep, where the change that they've had in incentives over the last year to be very, very low. However, they're kind of in two different boats. Jeep's incentives were already high, so there really wasn't much more upward momentum to go from that. Toyota, on the other hand, was low and remains to be low. In fact, they've got the lowest incentives out there. And so they're in a very, very good situation where they've got lean inventories, sales appear to be strong, and they're able to keep their incentives in check as a result. So the atmosphere out there remains quite varied across the different brands. And all of this is contingent on inventory. This comes from our vAuto data, and it's an update on what is on dealer lots across the country. And on the left, this is the available supply. And right now, we're up about 52% from where we were at the same point last year. We've got about 2.7 million vehicles on dealer lots across the country. Days of supply has risen as well. It now stands at about 76 days. That's up about 36% from where we were a year ago. So the inventory levels have improved dramatically, but we still remain far below the sort of 3.5 million level that we had in the pre-COVID days. And I think it's highly unlikely that we're going to see manufacturing kick up to get us back to those levels again. I think the industry is really going to try to keep supply below sort of a 3 million threshold so that we can keep a little bit of this lean and mean environment that we've enjoyed the last couple of years. But that's the aggregated view, just like we saw with the other data. When we look at the different brands, there's quite a different situation out there that exists for everybody. This is days of supply. As I said, nationally, we're at about 76 days of supply. That's how long inventory will last based on the current sales pace. But we can see on the far left here, Toyota, Honda, Lexus, they're in a much different situation. Their inventories are very, very tight. Their sales remain strong. So their days of supply remains very, very low. Well, at the far right, at the other end of the spectrum, we can see Ram and Jeep. They're looking at well over 100 days of supply for their products. Again, suggesting that their inventories are too high, their sales are not enough. We've seen that they have strong incentives. Incentives may even need to go higher for these brands if they're really going to be able to clear out the shelves and remain competitive out there. So let's talk real quick about what's going on with the alternative powertrains out there. One of the questions that we also ask in the Dealer Sentiment Index, and I just wanted to share this, I think it's kind of interesting, is what do you expect from the EV market in your area to look like 3 months from now? And if there's one thing we know that's happening out there is that the story that we've all had with EVs becoming the greatest thing since sliced bread, well, that's kind of all gone out the window. And the views on EVs have changed dramatically over the last 6 months. And even our dealers are saying that as well. And you can see as what dealers are saying the outlook is for EVs. Well, it's trending lower, certainly from where we were a year ago. So there is this sort of rising pessimism around EVs. But I will say, I think some of that is misplaced because I still think there's a lot of interest from consumers out there regarding EVs, and we're going to have more interest going forward. And part of the reason is gasoline prices. And I think this is one of the things that doesn't get talked about enough. But this was a major shock that the U.S. economy went through over the last couple of years. And that was that in April of 2020, gas prices hit a recent low until June of 2022, when the prices rose dramatically during this immediate post-COVID period. Average price at the pump rose $3.23 a gallon around the country, exceeded $5 a gallon on average for the first time. This sent shockwaves to people out there. People can't escape these costs. When gasoline prices rise like this, and I have to drive to work, it's a dramatic impact out of my spending capabilities for many consumers out there. And just back of the envelope calculations suggest that a $1 increase is a hit of about $50 a month for an average driver. And so we saw this shock. Now, gasoline prices did come down soon after, but they still remain elevated from where they were before. So I think this shock, coupled with the new products and all of the talk around these alternatives, does hit maybe not all consumers, but there's still a lot of consumers out there that are very interested in trying to figure out how can I escape my exposure to these changing gasoline prices. And so when we look at alternative fuel share, it's really taken off. And if we look at where alternative fuel share was in April of 2020 and where it stands today, well, it's pretty much been a one-way path, and that's been up. When we look at what share of the market is at this point, when we combine the plug-in hybrids and traditional hybrids along with EVs, they're now close to 17% of the market, and that's only going higher from here. And so all this talk about, well, EVs, people aren't interested in them. That's a lot of media hype. There's still a lot of interest in EVs out there. They maybe not as selling as like hotcakes like we thought they were going to, but they're still selling quite strong. And just looking at some of the Q4 sales of these powertrains on a year-over-year basis, battery electrics were up about 38% in the fourth quarter on a year-over-year basis. ICE vehicles were up just 2%. And so, the froth is off a little bit on these alternatives, but they're still selling out there. And they're going to sell more. And part of that reason is the Inflation Reduction Act. They implemented a massive $7,500 rebate. And that's something that can be applied for leasing. It can be used as a capital cost reduction. And when that's done, it doesn't have any of the income requirements that a purchase would have. Everybody can qualify for an EV lease and get that $7,500. And so that's going to save a couple of $100 off that monthly payment. And so the expectation is we're going to see a big surge in leasing out there of these alternatives. And when we actually look at the leasing data, that's exactly what we're seeing. This is looking at S&P Global registrations of what leasing share is of retail sales over the last couple of years. And you can see the Inflation Reduction Act was signed in the fall of 2022. By the time we got to the first of the year, you can see that strategies implemented by many of the manufacturers was to take advantage of the Inflation Reduction Act. And so we can see that purple line of plug-in hybrids and that green line of battery electrics rising dramatically as we see that leasing share starting to take off, thanks in probably in whole part to that Inflation Reduction Act. But what's interesting is not every brand out there or manufacturer is going to be able to take advantage of that. This is a chart that's looking at manufacturer fuel share of their own sales. And so you can see that for Lucid, Rivian, and Tesla, they're 100% battery electric. So they're 100% green. But you can see Geely, Volvo, they've got about 20% battery, about 15% plug-in hybrid, and then in red is the rest of their ICE share. And you can see as we look across that there's a number of brands like Toyota and Honda that have a big presence in hybrid electric vehicles. BMW as well as Stellantis, which are dabbling in plug-in hybrids. But you can see there's a number of other brands on the far right there that have very little to offer in terms of alternative powertrains. Mazda, Subaru, JLR, they're just starting to sort of make some offerings with electric vehicles and different types of hybrids, but they're certainly not particularly competitive out there. They're just dabbling in it. And that's almost 17% of the market that they're not going to be able to participate in. This chart's going to change dramatically over the next couple of years as more and more manufacturers are bringing their products to market. And so the sales volumes are going to change. But from where it stands going into 2024, we've really seen some domination by a couple of brands. Stellantis pretty much dominates the plug-in hybrid market. They account for about 40% of all plug-in hybrids that are happening out there, while both Toyota and Honda are dominating the traditional hybrid market. And of course, Tesla and their Model Y and Model 3 captures well over 50% of what's happening with EV. All right, so let's just finish it up by talking about the used market. This is a chart that comes from our vAuto data showing used auto sales. So far from where it stands today, we can see that the used market out there is running a little bit better than last year. We did just get the January registrations numbers in, and they were down just a hair from where we were last year. So we got a little bit of mixed messages on where used vehicle sales are right now. But our outlook is that we're going to see the used market increase just a little bit, very similar to what our view is on the new market. And it's really hard to imagine a much more robust used vehicle market until we see these interest rates come down. Used interest rates right now are above 14%. I think they're at 23-year highs right now. So if you're borrowing money to buy a used vehicle, you're going to be paying a whopping interest rate. And so it's hard to see that the vehicle market's really going to pick up much activity until those rates do come down. But the one thing that is coming down is used vehicle prices. And again, this comes from our vAuto data. We can see that blue line there that's showing the big run up in prices that we had in 2021 during the lean inventory times. We reached a peak back in December of that year, but prices have been coming down since then. And compared right now where we stand today, that purple line, we're down about 3% from where prices were a year prior, the same time a year prior. And in fact, prices now are back towards the levels they were in the summer of 2021. And so we have seen a bit of a reprieve. Part of this is the vehicle mix of what's selling out there. But certainly there's more negotiation going on. The dealers have been having to cut prices a little bit because we know that that consumer out there is facing real affordability issues. But what our expectation is that these vehicle prices are going to start to stabilize. And our expectation is that by the time we get to year's end, we're going to see that the values of used vehicles is going to stabilize. This is showing our year-end forecast of what we expect the Manheim Index to finish on a year-over-year basis. And we finished last year in December of 2023 with prices at auction down about 7%. And this is after they fell about 15% the year prior, but then the year prior to that, in 2021, they rose about 47%. Our expectation is that by the time we get to December of this year, prices are going to be down almost about 1%, flat or a little bit, more than just flat. But essentially getting back towards a more stable environment. And then our expectation is that by 2025, we're going to see things return back to normal regarding used vehicle prices, and we're going to get back to sort of a normal appreciation level like we had back in 2019. So overall, the outlook remains optimistic. As I said, both the new and the used market are expected to get a little bit better, but there's still a lot of headwinds out there and a lot of risks. Certainly, the Fed's policy actions are going to be one of the main factors out there we're going to be watching closely. As I said, the expectation is the Fed is going to start cutting rates here later this year, maybe as soon as May. There's kind of a mixed thought on whether that happens or not, but almost everybody's in consensus that later this year they will start to cut rates, and that should be a plus for the vehicle market. And of course, we have all the international concerns of what's going on in Israel and what's going on in Ukraine and all of that. But there's no way to kind of model that. We'll just have to deal with that if and when it happens. I will say there is some upside risks as well, though. As I said, the Fed has been managing this economy quite well so far. It's possible we could see much more aggressive interest rate cuts than we're expecting. We could see very strong productivity gains, very strong real wage gains. There are some upside risks out there. But overall, our expectation is we're just going to keep slugging away, keep seeing things get a little bit better as we move back towards a more 17 million market here over the next few years. So those are my comments today. If you have any questions, please feel free to drop me a note. And I think they'll be distributing this presentation so that you can take a look at it more thoroughly at your own convenience. So thank you very much.
Charlie, thanks so much for joining us today. We always appreciate your insights. Again, like Charlie said, you will all be receiving a copy of this webinar by early next week. To those on the line, join us back here on Tuesday, March 26th at 2 p.m. Eastern as experts from Bank of America give us an update on the interest rate market. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.